So how would you characterize the market in the first quarter?
Splendid. The Nigerian capital market has shown and started off January with a bit of promise. And when the political risk in the country heightened up and the sovereign risk went up, the Nigerian capital market naturally reflected the mood of the country, the doom and gloom, and that impacted on the market from about an 8% increase in the ASI. It came down to less than just about 1%. Yeah, but then by March 12, the market correction was completed. As at the end of March, therefore, the market had crossed over its 20 days, 50 days, and 200 days moving averages, which are basically measures of sustainability. And so, from our standpoint, I believe the meltdown is over, and the market is fully corrected, and there are pockets of issues which are natural for any market. You're not looking for a wholesome correction. And I'm of the personal opinion that the positive results from companies which you begin to see across the board and developments in the banking sector, indeed the financial sector, which accounts for 77% of the total market, still presents an issue. So how do we go forward? There are a few issues we will need to resolve from a regulatory end, from a market operations end, but suffice in that the market is out of the woods. I should say with all sense of responsibility.
Okay, what do you think are the driving forces for this market recovery?
In our capital market report for the quarter one, the drivers are simply this. One, the market had reached what you call a bottom. There was just nowhere for it to go anymore. But then it could stay flat at the bottom. But then the key driver and the key signal for the change was a decision by CBN, which was not directed at the capital market, but was basically designed to resolve a credit problem by reducing cost of lending or whatever. And so you find out that the interest rate in the money market fell to as low as 2%, to the extent that it just did not make sense for him. So when savings or investing in the money market became less attractive, the capital market naturally became the next source. And so there were penny stocks, these companies which are fundamentally sound on themselves, became attractive, because then you could go in and expect. And now, once you have that hard mentality also coming, because the money market just crashed and everybody moved in, momentum resulted in a capital market. And once there was momentum, it became attractive. So fresh money continues to go into the capital market significantly. That was the key driver. Second one was that the expected resolution of the bad debt saga has now been coalesced into the AMC bill, something I do not believe should naturally be like the all-in-all solution for the market. But then, once the House of Rep passed the bill, it then gave the market an inkling that, okay, fine. If the AMC bill, which very few people have seen, therefore passes within the context of what has been described to do, there was the palpable hope that anything that can help resolve the liquidity crisis within the banking sector, help resolve their capital adequacy issues, should be positive because of the weight and quantum it exercises within the capital market. And so the third one naturally became much of the key to the resolution of the lingering political crisis, the leadership crisis, the fact that the sovereign risk in the country had gone up. There were so many talks of turmoil, turbulence, and what have you. Once that became resolved, also in March, and you kind of like saw some sense of stability begin to exist within the political thing, the sovereign risk in the country also went down. There were other pockets of things, but principally those three things moved the market. And as such, the market has gained momentum. Now, the question is this: how well can we ride the momentum into quarter two? We believe the market recovery has begun. We expect that the decisions taken at the macro level should also support a market recovery. We're particularly delighted that the key players within the finance function are professionals, technocrats who would understand the same data me and other people also use, and as such we can reach some common sense decisions. Now, what the market needs right now is not some high intellectual strategy or something. It's just common sense. We are not creating jobs. Companies do well by creating jobs. In fact, there is a little snag. When companies are doing so well with less people, which shows that they have attained what I call an efficiency level, that they are doing so much with very less people, what is the attraction of bringing more people in? Now, we are still making money and doing well in traditional business areas, not new business areas. And so what the major market will be looking forward to is that, how do we create jobs? How do we create disposable income? The more we create jobs, create disposable income is there. If you take a look at the construction sector, which should naturally benefit in a developing economy like ours, it hasn't been there. If you look at the stocks in that sector, there are only 2 stocks that are doing anything. The rest are like moribund. We don't have more of those companies in the stock market, is there? You look at the telecom sector, we don't even have the key players in the SF Starcoms, which is just getting into a recovery mode, and they play at the low end of the market. And so you're looking at the key drivers in the economy do not necessarily reflect in the capital market, with the exception of the downstream oil industry. So the key players are not here. And so if we're talking about the capital market, we cannot, the economy, we cannot just talk about it in terms of the capital market, which still remains a very good measure of how things happen in the economy. So in one word, I would say that I expect quarter two to sustain its momentum as well. As long as we keep the political risk factor to a moderate level, not worse than it is already. It can only hopefully get better. We're able to sort out the leadership issues in both SEC and NSE, which should not naturally be a major issue, but for some reasons it's turned out to be a major issue. And we're able to address the margin loan issues with banks and the stockbrokers as well. We cannot punish them for having gotten involved in non-marginable facilities. We just need to deal with the problems. And then I think there is some common sense discussions going on in the market which should naturally lead to a resolution of that. So I think people should be a bit hopeful, but yet circumspect about certain stocks which don't have good fundamentals. And I believe we've been trying to identify 1 or 2 of them. So the hard mentality won't come. But I think it's a very positive outlook for the next quarter.